has finished, which means we might get started, if that's all good with everyone. But thanks for everyone who's joined so far. I might run through a little bit of we usually sort of run through our upcoming events before we get stuck into the meaty bits of what we're going to talk about today. So I'll do that over the next few minutes. But the next webinar we've got coming up on the 11th of March is actually a similar topic to what we've got on today, but it's all about restructuring your business structures or your entities for growth. We've been doing a lot of work with clients around this stuff, and the amount of benefits they can get from getting more appropriate structures is insane, including some massive tax upside as well, which never goes astray. The next one here we've got, which Riz is actually running, is our Save Tax workshop. So this is great if you're sort of sussing us out and want to sort of run through what our overarching highest impact tax saving strategies are. And sorry, I think actually one of our team is popping the links in the chat box as we go. If you do want to come along to this one. Also, if anyone isn't working with us, there's kind of options to reach out to have a chat to one of our accounting team. So we will have a link to book in a strategy call with one of our team. That'll go in the chat box at the moment. But if you do want to talk deeper with one of our accountants on this stuff, or what we're going to talk about today, then please book in, and we'll mention it towards the end as well. If you already are working with us, because I know there's a lot of clients in the joining live, then please reach out to the accountant that you work with, and they can sort of run through any implications for your structure and give you some advice, which is great. For those who don't know me, my name's Ben Walker. I started Inspire when I was 23 years old. I saw some photos of that era yesterday. One of the team dug up some, I don't know where, but I look a lot younger there. But started Inspire at 23. And I've had 13 years accounting experience, nothing compared to my guest in terms of experience. I'm also a foundation member of SPEPA, which we'll learn more about as we go. And I've been helping clients with estate planning, succession and asset protection in various forms and in various steps since 2013, which is actually when I started Inspire. We didn't do a lot of it at previous firms I worked for. They were sort of stuck in compliance, but very early into Inspire was when I started journeying into this stuff, because I saw the power it can give our clients. In terms of an introduction to me personally, that's a photo of my wife and two children on the right. That's the photo in the middle is my wife and my daughter, but she's a bit younger in that photo compared to the one on the right. Introduction to our team. So this is a photo of our awesome team, and also a cool stat about us as a business, that we've saved our clients over $18 million in tax. And I think we're about to crack 19 actually over the next week or two, with a massive win for a client. But it's not all about me and Inspire. We've got an awesome guest, Grant Abbott, who's joined us on the webinar this morning. He's the founder and chairman of SPEPA, which is an acronym for the Succession, Asset Protection, Estate Planning Association of Australia. He's got a Master's of Law specialising in SMSFs and family SMSFs. He's written 5 books on SMSFs, the latest being The Guru's Guide to SMSFs, which has now sold more than 2,500 copies. And he's provided more than $10 billion in property development, specialist investment, legal advice using SMSFs. And I kind of refer to Grant as my SMSF mentor. And if you're a client listening in, he's the guru. I learned all about suits off and all those really hectic superannuation laws, and how we can really get massive benefits out of our self-managed super funds. So he is the expert. So thank you for joining.
Yeah, no, thanks, Ben. It's very appropriate. I mean, it's I've been around a lot longer. I remember when I was your age, it was you obviously started very early in life. I had a different career. I went started at Touche Ross as it was in those days, and then become the research director at the Tax Institute. Was a state councillor and ended up working at KPMG and got out before partnership. I just didn't want to be tied down with a whole lot of other partners, and worked at Rothschild of all places in funds management, and since '96 have had my own business, and so focusing heavily on self-managed super funds. But over the last probably 5 or 6 years, I still got that big body of knowledge, but I can see that in terms of SMSFs, which is an $800 billion industry, over the next 30 years, the Productivity Commission has actually come out and said that there's a $6 or $7 trillion of assets to pass between generations. And I've seen families laid waste and laid bare simply through fighting from a lot of those ones. I mean, as you can see there, there's a fairly good case. Just to give you an idea, and I love a lot of people say, oh, well, but, you know, I'm dead and it doesn't matter what happens to it. Unfortunately, if you go in with that mindset, you don't protect the people who end up with the money are obviously going to be the lawyers. This Miller and Taylor case that you have seen just up there, you've got the Judge Courtois, or Justice Jeremy Courtois. Andre Miller died in 2013, so I think that was like same time you started up Inspire. So I'm not saying there's a correlation there, but anyway, he left everything to his children from the first marriage, and had an on again, off again relationship with a de facto for some time. And she made a claim against the estate, and she was able to do so. It was only a $600,000 estate, which you know, it doesn't matter. I've seen family provisions claims, you know, for up to $50,000, but 5 years later, it was finally settled in 2018, and the $600,000 estate had been whittled down to $80,000, wow. And the remaining $520,000 was spent in legal fees. So by the time they got all their awards and all that, there was just nothing left. And that's just the sad thing about it.
Yeah, and just to clarify, that 500K or so, that's to pay both sides legal fees, yeah? It's not just...
Yeah, exactly. So what happens is, and it's with that $7 trillion, there's already a lot of action in the legal community setting up litigation to do this. So there's probably a good chance, maybe 2030, and I would say within about 5 years' time, a 50 or 60% chance that your estate or your will be contested. And when it's contested, if you think about the process, so the process is you pass away, and this happened to my dad a couple of years ago. You pass away, then a lawyer or whoever's involved in looking after the estate will then go and get probate, which might take 3 or 4 months. You know, then you go through a process of like 2 or 3 weeks for probate. Then when probate comes around, the executor comes in, and the executor has to pay out all taxes, loans, anything else outstanding, and then whatever's left over can be left with the rest of the family. The problem about that could be from death until you get to that stage of administration. It could be 6 months. So it means your family is without any money for 6 months. Now, generally, it depends. If you're in Queensland, you've got, I think it's 6 months or 12 months to lodge a claim, what we call a family provisions claim. And if that's lodged, then the executor can't do anything until that's finalised. Yeah. And again, I've seen ones you can see here. You know, this Justice Jeremy Courtois has gone for 5 years over a $600,000 estate. And it really, for those of you who've been through divorces or separations or any litigation, generally the whole perspective is to obviously get the parties warring. And look, I've seen so many lawyers say, oh, look, it doesn't matter, you're going to end up with millions of dollars and stuff like that. But when it comes down to the end, the only people who end up with the millions of dollars are the Ferrari driving lawyers. So we've just got to be really careful about protecting. It was funny, actually, there was I just reviewed a case recently, and again, a lawyer came up, thought, you know, done a brilliant testamentary trust, you know, it's protecting it for the family and all that. And halfway through the advice, there was just this one little sentence that said, look, we understand that, you know, your daughter is to be left out of the estate and that she's a solicitor. And he just kept on going on. And it was like, well, all the stuff he's putting in place is irrelevant, because you need to address the fact that if you're going to get attacked or litigated, you need to really put a fairly strong protective fence, or what I like to call a moat, around your family castle, and just make it so hard for these lawyers, because a lot of them, if they're no-win, no-fee lawyers, it means that unless they've got a 98 or 99% chance of success, they're not going to take the case, because they're not going to spend hours doing on something that really is not going to come up. But when they start getting involved in these family provisions claims, they've already picked it up. On average, if there's a family provisions or it's contested claim, you're looking at losing probably between 20 to 30% of the estate just in legal fees. So if you looked at $7 trillion there, you have to say there's at least $1 trillion of legal fees over the next 20, 30 years. And you can understand why lawyers are starting to specialise in this family or this contested will stuff.
Yeah, awesome. There you go. Well, I guess we're all in the right place to learn a bit more.
You don't worry. I never attack estates. I just protect and defend them.
Fantastic. Well, could you give us a bit of background to Superannuation?
Yeah, so I originally set up it was many years ago, the Smsf Professionals Association of Australia, which is now the Smsf Association, with a number of people, and that's been going great guns. It's been around now for a good 20 years. But over the last probably about 3 or 4 years ago, you and I have had a lot of chats around this. Is that we see that there's a lot of lawyers who do estate planning, but they don't do that family wealth protection. As I just said, and that advice from the lawyer was all about estate planning, but missed the big one, which was the asset protection for the family, or the family wealth protection. So we can see that the key components of it, and it's a long-winded name, but and we want to go through it. I know you've got some great slides on that. That effectively you want to focus in on succession in the family. Now, it's up to you whether you want to keep your benefits or you want to keep your wealth in your bloodline or not. But it's not only this generation, it's the generation and the generations after that. So that succession is all important. In terms of asset protection, obviously, I've already talked about what happens on death, but we also want to have asset protection during our life. One of the areas there is that probably myself and probably you and Ben and many of your clients will go through and have our assets in our own name or our wife's name, or mainly because there's capital gains tax incentives to do so. For example, a principal place of residence exemption means I can go in, get a house, flip it in 2 or 3 years. There's no capital gains tax. The other side is investment properties are great. Look, my preference is I haven't got time. At some point in time, I'd love to come back and do a whole lot of SMSF strategies for you guys, because I love negatively geared property inside an SMSF. Outside is good. You get the tax benefit, but you can easily get that inside an SMSF. The only problem is that when it's in your own name, like your house, it all means that it's exposed. Where we've already talked about an estate, anything that's in your own name is exposed to a contested will. But if we have a look at it during our life, if someone wants to take a pot shot at us, a litigation, and look, all of us are going to be involved in 2 or 3 legal cases throughout our careers, particularly if you're a small to medium enterprise. As a consequence of that, there's no brain, because they'll just come and if they can see you've got a house, you've got investment property, it's going to be very easy to find a lawyer who's going to take a claim against you. It's even with Fair Work, I've been involved in what I think was a pretty spurious fair work claim, but ended up costing us $20,000 in legal fees. And the staff member hardly got anything. We had to pay 5 times the fee to the lawyer than the poor staff member got. And again, it's just the way it is. So we need again to and I'm going to show a little strategy later on. We need to protect ourselves against litigation as well, incapacity and obviously death. And if it really gets to a bad situation, and I feel, and it'd be good to have your views as well. But we are seeing quite a dampening down in the economy. I'm up here on the Sunshine Coast, and there's a number of businesses that have gone to the wall. They went through COVID and managed with JobKeeper and all that, but then with the with the Omicron and a lot of them, and we're talking about big players that you'd expect would be around for a long time. They're just shutting up shop. So it's that's obviously going to have an impact all the way down the track. So that if you've got a small to medium enterprise, you need to make sure you have asset protection going down the track. It's absolutely crucial. It shouldn't be 1 cent in your own name. You can still have assets in your own name, but they should have, and I'm going to show you a little bit later, your wealth built up in those assets, including the shares in your company, exactly the same thing. Anywhere, you've got to make sure you're not exposed. And that, we'll talk about this very shortly, that really then brings us back to the succession, that if you have to bow out, what are you really going to do? From running a company, and this is an absolute huge weakness in relation to that. There's so many companies, whether they're just single director or dual director, for example, 2 partners are in the company. The danger is if they both die together or one dies or is incapacitated. If you're stuck or you've got mental infirmity or whatever, that whole business, you can't do anything with that company. Now, a lot of people say, well, it doesn't matter, I've got enduring power of attorney that will cover that. Unfortunately, that doesn't, because in New South Wales, the Powers of Attorney Act doesn't have precedence over the Corporations Act. So in order to build a succession line, which is what I'm talking about, you need to build that into the Constitution, and you have pre-ready documents that will enable your successor director to come in just in play. And that's fairly important. That's an absolute crucial solution. So if any of you have got companies at all, you need to make sure straight away you go to Ben and you start to build succession in there. Because I've seen too many companies fail, because what will happen is if you don't have any directors in that company, and for example, you pass away, then those shares might fall into an estate. But again, if those shares fall into the estate, it doesn't mean the company's going to run, because again, if there's a no-win, no-fee, remember the executor can't do anything. The executor can't pass out those shares and put in place a director until post-probate. But if it's contested, then the executor can't deal with it. And that could be like 4 or 5 years. So it means that all the wealth that's built up there effectively is put at jeopardy. Now, quite often what will happen is the lawyers on the other side making the contest, they'll say, okay, well, we'll put in our director and you can put in your director. They'll negotiate that, and you really have got no negotiating position. So having something simple as a successor director, in fact, ASIC's released a guideline on it. So that's the body that looks after companies, and said you must put in place a succession plan for your company, because who's going to pay wages, who's going to be dealing with the government, any contractors and suppliers. So that successor director's solution is really important. Again, with a legal suit, we talked about that. I want to look at a solution later on I'll call the protector. And that's also useful for your death. In Queensland, you may not be aware, but anyone's able to make any eligible person's able to make a claim on the estate or contest the will. So all they have to do is de factos, potentially grandchildren, children. So if you're trying to keep anyone out of your estate, or you've got a spendthrift child, or a child is a drug addict and all that, you can't get rid of them unless you do the strategy I'll talk about a little bit later on. When it goes to court, and it's not you've actually got to end up going to the Supreme Court, depending on the size of the estate. And as soon as you go to Supreme Court, that's a $10,000 a day job anyway, because you've got to have a senior counsel, and then the solicitors and a junior counsel as well. So what happens in those instances is that that family provisions can really make a huge hole in the estate. So we just got to be really careful about that. The Queensland Law Council has set down guidelines on what judges, because what will happen in that case is you might think, okay, well, little Billy, and I've seen one just recently, it was a 63-year-old son who was left out of the will because he'd leaned on mum and dad for a long time. He's a drug addict, been in and out of bankruptcies for a long time, had 3 kids from 3 different spouses. So it wasn't really you certainly wouldn't give him a lump sum. But in the will, they tried to cut him out, and the court came back and said, well, hold on, your family's been supporting you all throughout this period, because all the lawyer had to do is show that his family had been supporting, which they had. But their view was that, we supported you all during life, so now we don't have to support you anymore. It actually works in reverse. It's if you have been supported all during your life, you are expected to be supported post-life, and it comes down to a determination. And this is really surprising, and it's only in Queensland that when they have a look at any of your children, de factos, and I've seen them go back 27, 30 years ago to de factos and spouses to make claims on the estate. Even if you've been divorced, I had one question from a client the other day who said, I've done a binding financial agreement, so I don't need to do one. I said, well, the problem is your binding financial agreement dies when you die. So that's the end of it. So they can still make a claim on the estate.
Jeez.
So I know it's a funny situation. So, but in Queensland, again, they use all that objective criteria. Have they been looked after? What are their necessities compared to, for example, the other children or the other spouses? And then what they'll do is, it's quite interesting, if it's a claim, for example, for that gentleman who, been a drug addict, they also take into account the needs of their spouse or their de facto. Wow. So by its very nature, the law is set up for the daughter-in-law or the son-in-laws or their de factos, and the de factos just have to be living with them at the time. It's not like a 2 years, just they're living with them at the time, take into account their financial needs as well. So Queensland really blows out. It's quite crazy. So we'll get to some solutions. I don't want to be a harbinger of bad news. I just wanted to tell you guys the truth and what's going on. So it's important.
Yeah, for sure. And I think we've covered a fair bit on the top 2 bullet points here, like why is it important now, and what does poor outcomes look like? But what's the value of having stuff like what's an example of this going well?
Look, the main thing is because we all know, if we've all got our business, we all know that we can only be, it's hard enough to build up wealth. But, it's funny, and you're probably seeing the same thing when, you get the tax office sends a huge assessment claim, or, they send a subpoena to your client. Your clients just aren't used to dealing with that. And then as soon as you get that, that'll freak them out. That'll freak most people out. And so then if you're not aware of the litigation process, if you've got that, you could be up for like 2 or 3 years dealing with the tax office, which, believe it or not, is a good thing if we structure it properly. But at the end of the day, just the stress involved in that whole process, and knowing that there's litigation there, the same thing is that everyone who's watching this, you've done your wills, but your wills can be completely useless. You might as well just go and throw them out, because all they are is really just an idea of wishes if your will's contested. So they're really of no value, because remember the executor can only deal with what they've got. And if it's all gone on legal fees, there's not much there. So I find that it goes beyond that. So I've talked about the negative side, but I'm finding that for most people, they really want to ensure that their family wealth is left for their bloodline and their bloodline only. They don't want it to go to the de facto that one of the children's been, hunched up with for, 18 months or something. And they don't want it to go to the stepchildren. They want to make sure it goes to their bloodline and their bloodline only, which is a common desire, I would find, out of 99% of people. No one says, oh, look, I don't care. Yeah, they might do it flippantly, but when you go down the track and start to ask questions, well, so that means you want it all to go to charity, or you want it all to go to the legal profession, so lawyers. As soon as you start doing that, then it's a completely different place in mind. But if you get it right and you get the strategy right, then it takes a huge weight off your shoulders as well. And you really need to have a good combination. Well, what I like to see is a good combination of a family protection trust, which I'll talk about a little bit later on, a really good family SMSF as well. And that's mainly for tax reasons. You know, we can set up I can set up an SMSF, and Ben can too, and really reduce, you know, taxation by a huge amount. And it's also fantastic for asset protection. You've got money in an SMSF, and your trustee in bankruptcy, your creditors can't touch it at all. So it's actually enshrined within the Bankruptcy Act. So you can't get any better asset protection than that compared to normal trusts. And if you've got, for example, a trading company, what the best thing to do is have that trading company being clean and having the assets sitting over a separate company, which is just like a service company. That's the shares are owned by a family protection trust, obviously, and then there's obviously a licensing or lease arrangement between the new company or your protected family company versus your business. So if they come knocking, come attacking, you just want to make sure that they open the door and it's like, oh, there's nothing there. Because if there's nothing there, what are they going to do? So that they might make you bankrupt. But again, if you've got that good line of succession, you're protected. And that's the problem. See, so many people just don't have anything, and they lose their homes, they lose everything. And it's depending on your age, it can be very hard to get back.
Absolutely. No, there's some awful stories out there.
Yeah.
But yeah, I recognise this this family tree might be a bit out of date. I think they've booted a couple of members out on the left side. But
there's our old mate Prince Andrew. So there you go.
He's not terribly popular. But it's
funny they boot him out, but he's still, you know, he's still line of succession if everyone else dies. But if you have a look at that, this is the royal family tree. So we've got Queen Elizabeth there. I mean, if I've had a look at like a couple of pictures of her lately, she's 95 and she's a cracker, but she's starting to look very, very frail. It's really last 2 or 3 years. Buddy Andrew, I think, is almost killed her, the poor thing. But the very nature is, you know, once she passes, automatically all the trusts that are sitting in her name automatically go down to Charles, as all the assets do as well. And then if Charles is not around or dies soon thereafter, it goes to Prince William. And then after William, it goes down to George and then Charlotte. So, and then if you have a look there, we've got Prince of Cambridge. So if we have a look at that, we've got a good line of succession, so we know what happens. If Charles, you know, goes crackers, then it automatically goes to Prince William. So the most important thing for anyone's family is security and certainty. But unless you've got a good line of succession, you can't have security and certainty in family wealth protection. As I said before, the simple thing is, you know, when you set up a company, and if you're the sole director or yourself and your wife, you both pass away, there isn't, or get sick, there's no line of succession there. So instantly it means that business, that entity is exposed, particularly if it's like an SMSF trustee company or a family or discretionary trustee company. So what we need to do is consider, and I always say to people, okay, well, let's say there's yourself and then there's your spouse. So both of you, the first line there. And then if something happens to one of you, so for example, if you're litigated against, so this was Ben and your wife, if you're litigated against, you just resign. So you're no longer really that person who controls everything. But then if your wife's not there and you don't want to be, there needs to be the next person coming down, and then the person after that. Quite often it'll be your children, but obviously not your children because they're too, they're too young.
Yep. But
the same way George and Charlotte will go in. I have seen people come in and have control, but they have an advisory board. So you've got youngsters in there, probably the age of your children. I wouldn't say that's the case, but if something happened to both you and your wife, you've got to think about who's the guardian, how they're going to be financially supported. do you want, your assets to be parceled up into a family protection trust that is then going to be looked after for your children, going down the track? And, then you start to think about, well, obviously you want the monies in there to pay for their school fees, but what sort of school fees? Do you want them to go to Nudgee or, one of the other colleges? Do you want them to board? Do you want, what sort of amount of money are you going to do there? And then, you're not going to, like a lot of trust funds, you're not going to let hardly any trust fund will let a child have access to capital before age 25. So when you have a look around that, you'll be able to get income, which will pay for school fees, living expenses, etc., for the guardian. But then you won't be able to get capital unless it's, for example, we generally write into the trust, unless it's for education, unless it's for buying a first property, and definitely health expenses as well. So you've got to start to look down that line of succession. So you might put your brother in there, but your brother might be more of a custodian for the benefit of your children if you want, and then you just pay him a relevant fee on that. So you can either take a stock standard approach, or you can actually tailor it very well. And the good thing about it is every family is completely different. So that when we have a look at that, we know that if we're going to get attacked, we move out. Obviously, when we pass away, that our line of succession should drop down to someone automatically. So we need to make sure that that next person, if it's our spouse, that's fantastic. But if you both die together, that's the hard. Who's actually going to take control then?
For sure. I've seen that's a very difficult question to answer for young families, especially.
Oh, yeah, definitely. And that's the hardest thing, is the guardian. In the wills I do, it's funny, actually, there's more fights about pet guardianship rather than children. It's terrible.
Wow. Okay. And I've heard with guardianship as well, like it's basically what you'd like to have happen, but it still goes through family court at the time. So
yeah, and also for the more sophisticated as well, the wills we do at Abbott and Morley, which I know that you utilise and etc. Ben. We're the first in Australia, and in fact, one of the first in the world to build a digital component in there. So you can have digital assets such as Bitcoin, cryptocurrencies, NFT, non-fungible tokens, all that stuff. And you can have because sometimes the executor, who's might be a spouse or whatever, all that stuff is just over their head. So you can have a separate digital executor as well.
Cool. Jeez.
Yeah, so it's we're living in a brand new world now, so we have to move with the times.
Absolutely. Well, I guess we're now going to shift into the different types of solutions that we can sort of put into a client's circumstances. And for the people watching, I guess this is, we might not want to go from, let's say, what your current structure is to all of these things. But these are the building blocks, depending on your circumstances, that we might want to consider as we look at your succession plan and your asset protection, and obviously your estate planning as well. So, yeah.
So the leading member discretionary trust. So we've got two. They're both the same names, but I've got a leading member discretionary trust for what we call a family protection trust. Essentially, they're completely different to those of you. If you've got discretionary trusts, you'll normally have someone who's an appointor, and then you have the trustee, which might be a corporate trustee or individuals, and then you tend to name a whole lot of beneficiaries and their spouses and so on. So it's not bloodline related. It's just like it's a blob, and really it's a good one for tax purposes. Generally, most of the ones set up are not very good for asset protection. So if you go back to that succession, you need to say, okay, well, if we're using a discretionary trust as a standard vehicle, then we need to look at who actually is the key person in the trust, and it's the appointor. So the appointor has the power to appoint and remove beneficiaries, and also appoint and remove the trustees. So they're like the queen, they're the big kahuna. So what we want to do is we want to have that person, and we call it the leading member appointor, or in a family protection trust, the family protection appointor. So what transpires from that is a couple of fairly important things. So just to show you the difference between this and an ordinary trust, there is no beneficiaries named. The person who is the leading member appointor is the beneficiary. Now, with that one, it then includes all their bloodline, and includes also prior leading member appointors and future ones as well. So when you go down that line of succession, I've seen people go down 6. All of those people are potentially first line beneficiaries, as are their bloodline as well. So that then creates, when you go through the process, if it's not joint leading member appointors, your spouse isn't included. And quite often people who in there have been through a very bad divorce, getting in a new relationship, they tend to leave the spouse or the de facto off. So they just want to keep that in a closed loop there. So what we do is it's really focused on the leading member appointors and also who their bloodline is. Now, generally, because we're building this for longevity, and it's going to hold, this is our castle, this is going to hold all the family crown jewels or the family wealth. We want to make sure that it goes, one of the weaknesses in trusts in Queensland and many other states is that once you get to around 80 years, you have to wind them up and dispose of all the assets, and that creates capital gains tax and stamp duty issues. Whereas what we do is, even if it's a Queensland trustee, Queensland assets, we can still choose the jurisdiction to be South Australia, which is my old hometown, and that means that 80-year rule doesn't apply, so they carry on into perpetuity or forever, which really starts to see these really long tail trusts that can be established. And it means that obviously we get more and more structuring, so that if this is our crown jewel and holds the majority of our wealth, when mum and dad die, we then now need to build in provisions in there. For example, splitting the trust between the 3 children. So each child has its own little sub-trust within there. And again, it's very stamp duty and also tax effective because there has been no disposal. It's still all owned by the trustee itself. So again, from my perspective, there's also great asset protection. Unless you generally, if you're seen as the controller of, because it's very hard to go through the trust, except if it's like family law, they can do anything they want. It's very hard to go through the family trust. They look at whether you're the controller. By the very nature that you can distribute to companies, you can distribute to bloodline and all that. If you're not that family protection appointor, the leading member appointor, then you're clearly not the controller. So if you do get into a bit of strife, then you simply jump out as the leading member appointor and also no longer a director on that corporate trustee. Now, what we've got a special purpose corporate trustee, because the issue I talked about, remember, the shares can be exposed. So what we've got there is, if you've got a leading member appointor, then they're the only shareholder of that trustee company. Now, when they pass away or they resign or they just want to get out of it or incapacitated, then they resign or they get replaced as the leading member appointor. The next person comes in, but at the same time, the next person comes in is automatically appointed as a director of the trustee company if they're not there already. Plus, the shares of the prior leading member appointor are cancelled and new shares are then issued to the next one. So we don't get anything caught up in the estate. So again, it's better than the successor director solution, because the successor director solution still leaves the shares hanging, whereas this leading member of family protection trust makes sure that there's an orderly transition that happens just like that. And the good thing about trust is, if that's where your wealth is, you can, if someone passes away, you can actually pay straight away out of that trust. Funeral expenses, looking after the family, nothing should change. It's just simply the appointor and the trustee carries on. And that's why it's important to have someone like Ben who can get in there and get involved straight away and reshape and recalibrate things and make sure that everyone's cash flow needs are looked after. Whereas if it goes into the estate, it can be a perilous situation for years on end.
Yeah, absolutely. And then for our clients, like we've obviously got, like, there's massive benefits for sitting wealth inside of super, but for the wealth that's held outside of super, this is kind of our preference, is to keep most of it here, or all of it. And it's almost in a way like a second super fund.
Yeah, I look at it because I love my super. Obviously, I've written all the books on it. So, I like doing it. But as you get a little bit older, the danger is that if one of the elderly couple dies, that we might end up with just too much money in super, if that makes sense, because you only really need enough in there. So there's two ways of doing it. Is when you set up an income stream, again, this is probably the best way around a contested will, so that if you're setting up an income stream, it might go from yourself to your spouse, and then to your children. Your children can't take an income if they're over 25 unless they're disabled. They can still take it as a lump sum, so that it pass the parcel, which is useful. You can even set it up if you're paying the grandkids' school fees. You have an income stream that goes grandpa, grandma, grandkids if you want. And that's very tax effective, because the money stays inside the super fund. I've already said that's not able to be accessed by a trustee in bankruptcy. But if grandpa was on tax-free super because he's over 60, then the grandkids, even if they're 4, 5, 10, 15, it's also tax-free super for them. So that's a great way. But as soon as you die, it automatically passes over to the next person. So that means it can never go into the estate, because that part of property just evaporates on death. So that's one of the best ways of doing it with super. But as I said, that you might end up having one of these, and then at the same time, because there are limits on what you can have by way of an income stream or a pension out of your own self-managed super fund. So you might end up with a large amount sitting in an accumulation account. The danger about that one is that when those monies are passed out, unless it's been monies that you put in that are non-tax friendly, or been actually after pocket monies going in, or what we call non-concessional contributions, anything over and above that, when it comes out, is taxed at 17%. But if that's backed by a whole lot of assets, so you have to wind up that person's estate that's reflected in some of those assets, you might be up for capital gains tax of 10% plus another 17% going out. So I'd go back to you, at some point in time, it makes sense that you run with your super, because it is tax effective, but potentially pull your super out, the stuff you don't need to generate that income stream or that ongoing income stream, and then put it into a leading member discretionary trust. So settle it in there, and then start to build your estate planning, because there's no tax on the way out.
Yeah.
I said when you die, but anyway.
Yeah, and you've even got a solution that may help that, what you just mentioned as well, that 17% tax. But
exactly.
We've been talking about SMSFs a bit already, but what's the difference between maybe like a normal SMSF and the leading member?
Okay, so I've got a bit of a different take on things. Again, a lot of my strategy, all my strategies generally come from my own family experience. Mum and dad were in an SMSF for a long time, right from the start. Even dad was in a allocated pension, or personal allocated pension, way back in the 80s. So they've been in an income stream, and dad had dementia many years ago. So by its very nature, dad was the leading member of that fund. Mum was in that fund, but really it was straight over the top of her head, which is fine. But because dad had mum's enduring power of attorney, she could be a member, but she didn't need to be a trustee or a director of the corporate trustee. So likewise, when dad started exhibiting dementia or forgetfulness and all that, it was his turn to move out. So then, not myself, because I wasn't in the fund, but both my other brothers held my parents' enduring powers of attorney. So that line of succession comes down. Now, what I've done to bolster it a little bit further is, if we have a look at the leading member, one of the dangers about it in the past, I came up with a solution many years ago, which I don't use anymore because I use this leading member, is that, I've always said that you can now have 6-member family super funds. And if you're on that line of succession, you need to bring in the next generation anyway, because if something happens to your parents, they're demented or whatever, you want to still keep them in there from a tax perspective, but you don't want to give them you don't want them to be a trustee. It just doesn't make sense. So again, as long as you've got their EPO, their enduring power of attorney, and Ben can draft you up one that just looks after super if you want, then effectively you can have just like one member or two members who are directors of the corporate trustee, but you might have a 6-member fund because they hold the enduring powers of attorney. It's also worthwhile too, and I would hasten to add, and I think this is, I had a very, one of our directors had a very unfortunate experience of losing a 13-year-old daughter just recently, which was very, very sad. It's very hard. She'll never get over it. But, you know, while her daughter was waiting in that position, that effectively, you know, if she had to be handicapped for the rest of her life, that has a huge financial wherewithal. So I would again say that anyone, whether you've got grandkids or children who are young, even, you know, probably yours are a little bit young there. Actually, probably not, Ben, but having a look at a solution of having total and permanent disability insurance inside the fund for them. They don't need to have a balance, but just to make sure that if something goes wrong, you're going to have the financial wherewithal, and it virtually costs next to nothing. Now, the problem that we had many years ago is bringing in a number of family members is that, well, if you're sitting at a board, all members have the same vote. Now, what I came up with, and I said, well, I came up many years ago and said, look, what you should do is a proportionate vote. So you get votes proportion to your account balance. But that sometimes works and sometimes doesn't, because the leading member or the key person in there might have a lower balance than, say, their spouse or whatever, they get kicked out. So again, I've come up with this new concept that we now designate the same way we've got that leading member trust and that line of succession, we can have the leading member inside the SMSF. Now, in that one, there's no proportionate voting. Everyone gets the vote, but it's a bit like the US president, is that the leading member can veto any action. So they really control everything out of that whole process. And again, if something happens to them, then it passes down to the next leading member. So if you've got everything right, so you've got your family protection trust, your leading member trust, your leading member SMSF, the line of succession should be exactly the same. And if you got, because you have to do enduring powers of attorney, so the enduring powers of attorney should also be exactly the same as well.
And so that power with the leading member SMSF, because one of the things I remember, like this is really early days of me learning about this stuff, is if you've got 4 members or 6 members in a fund, and let's say you've got the son-in-law or daughter-in-law in there as well, where there's a bust up in that relationship, as a leading member, my understanding now is that you can actually boot that in-law out, pay their super balance to somewhere else, and force them out.
So it's even better still to, if you bring them in, it's on the proviso that they give you their enduring power of attorney over super only if they want. So they can give their spouse an enduring power of attorney over their personal and financial affairs. But we've developed an enduring power of attorney where you can give someone else your enduring power of attorney just for super, which sits quite well. So again, that bolsters that leading member. And again, it does, because generally my thematic always has been that, you know, never have daughter-in-laws or son-in-laws or whatever inside the fund. But since I've moved to this new style, you can get them in, but build within the deed is, well, if the leading member doesn't like them, they often do is just tap them on the shoulder, and they've got 60 days to get out. And if they don't choose a fund within 60 days, then it ends up in the ATO's repository of superannuation.
Yeah, good. That's a fair bit of control, and definitely reduces that risk. Also, superannuation, I've just actually implemented this for one of my family members. So could you walk us through this family allowance?
Yeah, so one of the elements there is we talked about tax. So being able to pay, so there's 2 questions. It doesn't make sense, and this like extremely frustrates me, is that you'll see a lot of lawyers will actually take money from a SMSF or superannuation fund and put it to the estate to then get contested. Whereas if we deal directly from the SMSF, which is the same as a company, it's governed by federal law. So these state-based family provisions laws in Queensland don't apply. So we want to look after our beneficiaries directly. So in order to do that, we need to show that they're dependent. Now, all our adult children, all of that, they're all treated as dependents. So from that perspective, if I've got my brother, I can't look after him separately unless he's financially dependent on me. Now, that's just the superannuation laws. But when we come around to the tax laws, they've got a bit of a different angle on things. As I said, that if the money sitting inside the fund really have been from gains or earnings in the fund, from salary sacrifice or deductible contributions you've had in there, that when they come out, they're taxed at 17%, unless you're a spouse. Now, the one exception there is in fact, there's a couple, but the main one is if you are a financial dependent. Financial dependent is something that's determined at the time of the death of the individual. I think I go back to your strategy, Ben. I think the best one is to pull it all out, put it into a family protection trust before we go this. But if you are stuck and this happens, it's best to show that you got to show someone's financially dependent upon you. And it doesn't have to be wholly, it's just that it's partially, and that their existence in life is improved because of that ongoing continuous support. In all the cases, they're high court cases, there's always this ongoing continuous support. So there's been a number of ATO rulings saying that, for example, paying a dad who had been separated from the wife and his children were outside or living with the spouse, just paying those university fees on a consistent basis, they're held to be financial of the dad. And as a consequence of that, when the death benefits came out, there was no tax. And I've seen just, kids paying board to their mother. The mother would be treated as a financial dependent. So if you can get into that position, then you will do that tax saving. So the family allowance agreement is it becomes more of a contract, but it can be terminated any time. That monies will be paid by the senior members of the fund or anyone down to a family. And then that family, it's not only just one person, it's the whole family can then be looked after through that family allowance agreement. Now, you can't guarantee anything because, the courts and everything changes, but the Commissioner has been given some very favourable rulings along this line. But if you don't have an agreement in place and you don't have that evidence of ongoing support, then you're going to have to rely on what you rely on. I see too many people come and they say, oh, well, we gave our son $250,000, 2 years ago. We want to show that he's a financial dependent. Well, it's not working because it's not ongoing continuous, because they would have been better off, even if they lent him the 250, put up a 5 or 6% interest rate, and then just forgave each of those payments over a period of time, or forgave some periods over a period of time. That would have been a much better way of doing it. So again, the family allowance is for super is absolutely crucial.
Awesome. And we've just got the one more strategy before our big one, the protector at the end. But
we've talked about the successor director before. Remember, the best one is the family protection appointor, because that's inbuilt, shredded into the documents. But the successor director, when you go through there, we build it into a situation so that obviously you've got to make sure your company constitution enables it. It's very easy to change constitutions. You can change them virtually every week. You just have to have a shareholders meeting, throw out the old one and put in the new one. So as long as that's got that capacity to do that, then you put in place a couple of binding resolutions saying that, in the event of something happened to me, this is the next person to take over, this is the next person. So you don't have to deal anything with ASIC or the company's regulator at that time. It's only if it ever comes to fruition. One of the things that is also there is a deed of indemnity, because you don't want the person coming as a successor director and then being hit with all the liabilities of the company. So again, there's a deed of indemnity that comes in, and it's a nice tight little solution there. But anyone who's got companies, if you're not going to look it down that leading member trust, if you've got a bucket company or trading company, you've got to put in place a successor director yesterday.
Yeah, and so what you're sort of saying there is this is almost like the Band-Aid solution, but the better long term is that leading member trust or
Yeah, well, that because that's all built in, it's really tight in all the constituent documents. It's fine, but we haven't got that in this successor director. So this is again, it's tight and it works perfectly. But remember, we've always got those shares hanging, and so when you're dealing with a successor director, you've still got those shares hanging around, which is a trouble. Like if you've got trustee bankruptcy or that contested will, whereas remember the leading member does the successor director, but it also looks after the shares as well.
Yep, for sure. All righty, the big kahuna, the
protector. So again, we talked about it's quite a sophisticated strategy, and there's a lot of documents to get in place. And it's been around for maybe about 20 years. There's been a number of court cases on it, and they've always, provided the documentation is on point, they've always been held up to be fine. So again, if we've got a family home, investment property, shares in our trading company, anything that's in our own name, as I said before, it's great for tax, negative gearing, great for tax and family home, principal place of residence, but it's terrible for asset protection if we're litigated against during life. And also estate, it means it potentially falls into that contested will character. So the first thing what we want to do is we want to build that family protection trust. Remember, we have the family protection appointor, it's for bloodline only. If you've got other people you want who are not bloodline, there's the special rules in there that enables the family protection appointor to put in place someone. For example, we could put in place Nick as a beneficiary, but you might limit it to a year or 2 years, or while they're good friends, or while they're a good child, or whatever. So you've got a lot of flexibility around that. So we put that in place. Again, we've got our bloodline beneficiaries. Remember, we want to have that succession place. So who's the first family protection appointor, second, third, and fourth? Now, what we do is, did you end up getting that picture just so I can explain it? Perfect. So what we do is we look at all the assets in your own name, and we go down to a level that even like, watches, obviously not although you never know, Casio might be making a comeback, they might be vintage, but any flash watches, the sort of stuff that that Ben wears, some really nice stuff. Company shares, company shares, family home, cars, and we don't necessarily need to focus in on the assets at this stage. We want to find out what the net wealth is, and in this instance, the net wealth is 1.6 million. So it might, for example, the home might be worth 2 million, but it's got $1 million first mortgage on it by the bank, which is fine. So what we do is we get that 1.6 million. And so if I did a personal balance sheet of mine, then it's the 1.6 million is all the wealth to my name. Now, remember, it excludes current SMSFs and excludes current stuff inside trust, because they're already protected from trustees in bankruptcy and family provisions claims. So we're just trying to get the stuff that's in our own name or in joint names. And so what we do is we get the 1.6 million and we gift it into the family protection trust. Now, we haven't got any cash at that time because it's all tied up in the assets. So what we do is we issue a promissory note. So the gifter says, okay, well, I'm giving you this promissory note, which is like an IOU, $1.6 million. The best way to think of it is just the act that actually brings in promissory notes also deals with checks. It was actually issued first in 1909. So it's a long body of law around it. So you do a promissory note that's payable on demand. And so suddenly that will reduce the wealth of the gifters or the individuals yourselves, and now passes it over to this family protection trust. So the family protection trust has actually increased. And it works well in Australia. It doesn't work so well overseas because in Australia we don't have gift tax, whereas all other jurisdictions who have death duties, death taxes, what they do with that one, they also have a gift tax as well. And I can tell you within the next 5, 10, 15 years, there will definitely be death duties or death taxes. It's just simply there's that $7 trillion being passed. The governments can't really miss out on that when they have a look at a budget, because anyway, that's part of the story. So the wealth has been increased inside the Family Protection Trust. So what they do is you then get that wealth and then you lend it back to the original person, so that they've still got all the assets in their own names, but there's no value there. So they're just simply legal title holders, and almost holding it on trust for the Family Protection Trust. The result of that is that you'll then go into second mortgages for properties, and then to secure, for example, the cars, the watches, the loans on that, you can go into what they call the Personal Property Securities Register, and that can all be done fairly easy. We've got services to do that one. So the beauty about that is there's no transfer in assets. So there's no transfer in assets, there's no capital gains tax and no stamp duties. I mean, ideally, it'd be great to have all those assets directly inside that Family Protection Trust or Living Member Trust, but we don't need to do that because we've just simply transferred the wealth. If you get sued, because what happens is the trustee in bankruptcy can claw back or make void transactions such as gifts or anything that's undervalued, and it's only got a 4-year period now. So if you put that in place now, within 4 years' time, by the time 2026 comes around, it doesn't matter, so they can't go back. But generally, our practice, you'll find that if it's been in place for 1 or 2 years, they generally don't try and claw it back. What they'll do is they'll negotiate a settlement, which might be 10, 20 or 30%. So again, you want to put it in yesterday to get it down the track. If we have a will, then what happens is, remember, I went through the process. You get probate, you get the executor. And remember what I said for that is the executor has to pay off all loans. So the first thing the executor has to do is transfer those monies over to the Family Protection Trust. And once they've done that, hopefully there's going to be nothing left in the estate. So the no-win, no-fee lawyers aren't going to get anything because it's now all consolidated where Ben said is that Family Protection Trust. And again, we're just going to make sure we get those family protection appointors really well. At a first level point of view, the Family Law Act, if you're the appointor of that Family Protection Trust, they'll be able to go and say, well, hold on, you're really controlling it. But when it's passed down to the next generation, or if you're not even involved in that Family Protection Trust, if you're concerned about it, then in that instance, it won't become matrimonial property. So again, family law is like its own little blissful area, but you can protect yourself for it. But when we talked about estate planning, so the Family Protection Trust is great. If you already in for a first mortgage with a bank, then what you can do is the people that we use to register the mortgage, the legal services firm, they'll negotiate with the bank for you. So that's you just pay a flat fee for that. But that then secures that mortgage, because you don't want to be in a position that your executor says, well, hold on, I'm going to pay secured creditors first, then everyone else if that's not secured. So you'll make sure you've got security over that.
Yeah, fantastic. No, I think that's one of the best outcomes is having that all in line. But sorry, we've gone a bit over time, everyone, but we're almost at the end and open for Q&A. But tell us about the ebook.
Yeah, so I've got all of this and all the steps involved in the protector and how to protect family wealth. I've got all of that laid out in terms of the book. And if you want to get that from Inspire, there's no cost to do so. Just let the team know. And I've also done a video, which because I've only just done this in 5 minutes. You want to, before you explore anything, you want to go in and do a deep dive. Yeah. And I'll take you through everything of all the steps and the orders they need to do, what needs to happen. So have a look at, some people like videos, some people like books, so you can actually have a look at both to make sure you're 100% certain on the efficacy of the strategy for you. But if you're in a small business, well, if you've got assets in your own name, you need to do it anyway.
Yeah, absolutely. All righty. Well, I'll do a quick wrap up and then we'll shift into some Q&A. But just a reminder for everyone, if you want to sort of check out the webinar recordings, we're posting them on our social media now. So YouTube will have the full recording, same with Facebook. So give us a like. We've also got tons of other information on our social media channels. So all these other topics as well, all around tax, accounting, all that fun stuff. So check us out. Also, if you aren't working with us yet, or you want to suss that out or have a chat more about what we talked about today, then feel free to book a phone call with one of our accountants. We actually just set up a thing where you can book a Zoom so we can actually see you face to face. So yeah, love to do that. And also, if you are a client, you've seen something that sort of sparked your mind here, then please reach out to the accountant that you work with at Inspire. They're all clued up on this stuff. And we've done extensive training. So yeah, please reach out and we'll be able to help you with that stuff. So thank you for joining. If you've got to go, that is totally fine. But now we're open for some Q&A for maybe 5 minutes or so.
Yeah, so just chuck anything on, or the guys will pick it up, and happy to answer anything.
Yeah, so I've seen a question from Paul. Paul's asked, is there any suggestion of how much I should provide to each person in my will so they can't contest to have more than I decide? So it's that amount. And
it doesn't work, don't worry. So you'll find when I build a will, so I'll go through this couple of questions. So when I build a will, you'll find there's a section within the will that you can reduce or say, look, I'm only paying them this much because of blah, blah, blah. But remember, it's family provisions. So they'll look through all of the contestants or all the children. And remember, they can go back to de factos and spouses ages ago. And then they'll look at who really needs the money, who needs the support. So you might say, okay, well, I'm going to give it equally to all my children. But if one child actually needs a lot more than the others, and they make a family provisions claim, there's a good chance they're going to get it. And usually it's the ones that you want to leave out or reduce the benefits are the ones that really will be supported more by the court. So again, the better style to do is put in the place the protector, get that right, and then you'll still do your will and put all that down, but it's immaterial, because if we make a challenger, there's nothing there, then it's all the material.
Yeah, no, fantastic. That's it. There's nothing actually to contest.
No, we can't contest nothing. Well, sorry, we can. As I said, there was a case, the Victorian Supreme Court, I think it was in December, and it was for $50,000 for making a claim. And this is the Supreme Court, so it's cheap. And the executors, legal or lawyers, argued that there should be a de minimis rule, which is, well, $50,000 is ridiculous. It's too low, and most of it's going to go on legal fees.
Yeah.
The court said, unfortunately, in the legislation, there is no minimum, there's no de minimis. In Queensland, it's not too bad. I think as if it's a sizable estate, is a Supreme Court. Otherwise, it goes to district court. But even with district court, it's still a very expensive process.
Yeah, geez. There you go. All righty. Well, there's no other questions I can see coming through the chat box. Does anyone else have anything that want to run past Grant or I before we go? Paul said, thank you. In this case, would I just give the specific amount of money to each child before I die?
Yeah, that's a good one too. In Queensland, that works out. In New South Wales, you can actually claw back if it's within 3 years, but Queensland's perfect. So again, gift it, but just be careful when you gift it, is that again, if they're in a relationship, and I'll tell you how I'll go through one instance that was a client who went through this whole process of setting up a family protection trust. Everything was fine. And then what they did is they made their spouse the family protection appointor and all of that sort of stuff.
Yep.
And as soon as that happened, and I said, you shouldn't be doing that. But as soon as that happened, within a month, his de facto left him. And so now he's out and about. And there's the same sort of thing, is that if you give a lump sum or an amount to your children, then that becomes matrimonial property. So you're best off putting it in a trust, like a family protection trust, before you pass, and then have it split between the 3 children. and then have some terms and conditions around it, but then none of them actually control it. So it means it's not matrimonial property for family law purposes, and the same with litigation as well. Yeah, you just don't want to give money directly to kids without strings attached.
Yep, beautiful. Fantastic. All right. Well, thank you, Grant. I can't see many more questions coming in, so we might end the webinar there. But just again, thank you so much for your time and appreciate your sharing your knowledge with us and our clients.
Fantastic. Anytime.
Yes, it's benefited them extremely. I reckon your strategies that we've learnt is probably a good quarter of our total tax savings. A few $1 million easy.
Perfect. Well, let's boost it up. Let's double it and double it again.
That's it. Awesome. All right. Thanks everyone for joining, and again, one last thanks for Grant, and we'll
okay. Thanks, guys.
see you soon. Cheers.
Bye.